Good morning, everybody. We'll get started here in just a second.
Recording in progress.
Alrighty, good morning and welcome to year-end tax strategies for business and individuals. My name is Jessica McClellan. I'm the practice growth manager here at Vaughan Company, and I'm going to be your moderator for today's webinar. Before we begin, we have just a few housekeeping items. During the presentation, we ask that all participants remain in listen-only mode. That means your cameras should be off to reduce disruption and that you are muted during the entire presentation. There will be a question and answer session at the end of the presentation using questions submitted via the chat feature. The chat feature, you can ask a question at any time during the presentation. Simply click on the chat panel in the lower right-hand portion of your screen, and you could submit a question to our panel. We will have someone specifically on the webinar today to answer those questions live in the chat feature. And then if we have time at the end, if there's questions that seem to be quite popular, we will address those at the end of the webinar. Finally, a recording of this presentation will be made available in the days coming. We will be sending an email out to all participants or registrants with the information and the recording of the webinar. So let's get started. Another tax year comes to an end, business owners and individuals are looking for ways to maximize their tax saving, especially in light of the recent changes under the Inflation Reduction Act and more potential legislative changes on the horizon. A proactive tax approach can help you and your organization make strategic decisions for financial success. Today, we have with us a stellar panel. We have two key members of Vaughan Company's tax team, actually three. We have Bob Bradshaw, who is a partner who has been with the firm for over 13 years and is well-versed in the nuances of tax code. And Ruben Becerra, a senior manager who brings more than 9 years of experience. And then finally, we have Michelle Clement, who is a partner on our tax team, who is graciously agreed to answer our questions in the chat feature. With that being said, I'm going to go ahead and hand it over to Bob and Ruben.
Thank you so much, Jessica. And thank you all for coming this morning to listen to Ruben and I discuss taxes. I'm sure as you may have heard us in the past, you know that Ruben and I absolutely love this to be able to discuss the taxing situation that we're in and absolutely geek out over the code sections and the way we are able to help strategize and just help reduce tax bills and get into the best situation for our clients and anyone really. And again, as Ruben and I do often, we pontificate about taxes at our home, and our spouses don't seem to like it. So hopefully you guys will get something more out of it than they do. With that, we're going to turn it over to Ruben here to talk about what we have actually seen happen in 2022. Ruben?
Yep. So if you'll recall, this time last year, there was a lot of uncertainty when we were doing these webinars and some of the others that we've done. A lot of uncertainty with pending legislation that was out there between Build Back Better and a couple other bills that we talked about that had the potential to have some pretty big impacts from a tax perspective for individuals and businesses. So fast forward to now, obviously, as you've seen, a lot of that legislation did not come to fruition. The big bill that did come to fruition was this Inflation Reduction Act. And so this act does have some of the provisions from the Build Back Better bill, but definitely not to the extent of that bill, and definitely not to the extent that it would have impacted individuals and businesses with this act that came through. But just want to highlight a couple of big ticket items from there. Because there was some that have the potential to affect us from business and individual side. That first one being the corporate minimum tax. So this is something that's not going to affect a lot of us.
Hopefully it affects you.
Yeah, it would be nice, I guess, if we were in that situation, but definitely not going to affect a lot of us, a lot of our clients as well. But this is the tax that if you have adjusted financial statement income above $1 billion for the previous 3 years, then you get hit with a 15% corporate minimum tax on that income. There's some kind of nuance there if you're a foreign-owned corporation and you have over $100 million of financial statement income. But again, still just not something that's going to impact a lot of us and a lot of our clients, but just still something to keep in mind. Second one there is that 1% excise tax on stock buybacks. So this is specifically for publicly traded companies when they repurchase stock from a key investor, stockholder, key employee, something like that. And it's in excess of $1 million. And this is when that 1% excise tax kind of kicks in. Again, not something that's going to hit a lot of us because of that publicly traded aspect, but still just something that we wanted to highlight. So the big kind of ticket items that came through in this act were the energy credits. There's a ton of energy credits in here, between credits that were extended, credits that kind of became new, that we could go on through. Some of them are kind of specific, yeah. So not necessarily going to hit everybody on a wholesale level. But some of the big ones from an individual perspective. So there's that annual energy efficient kind of tax credit that, if you recall, has typically been a $500 lifetime credit. That's now a $1,200 annual credit. So some potential there that we might not have been able to utilize in the past. Also, the clean vehicle credit that kind of replaces the energy or the electric vehicle tax credit. So there was some decent amount of changes there between taking off the limits on the number of automobiles that you could have in service at the time to be able to take the credit. But there's also some new requirements as far as it needs to be finally assembled in North America. There needs to be like MSRP and income limits for yourself to be able to get the credit. So some nuance there that kind of all takes effect in 2023, but still another big one that probably is going to could potentially affect some of us at the individual level.
So basically, if you've done anything green, let's look to see if there's an energy credit out there for you.
Right. Yep. And then we have there too the 179D that was kind of expanded in this act as well. So that's just the deduction that you can get from energy efficient buildings.
Right. And the key aspect there on the 179D is it used to be you could only get it from governmental builds. They changed it to all nonprofits. So this is going to be huge in the construction industry that you're able to now get that deduction on your return if you ask for it from nonprofits as well. And they jumped the credit from, I think, $1.25 up to $5. So we're going to see a lot of 179D deductions that are going to really help out some of our taxpayers. Yeah, for sure. The next item there is that extension of the 461L loss limitation. So if you recall, this was something that came about with the TCJA that was set to expire in 2025. There was an act that came out in 2021 that extended that through 2026. This act comes out and extends it through 2028. Essentially what that is if you have excess business losses above your business income, those are going to be carried forward. You're not able to reduce your regular taxable income for those losses. Yeah, and that's at $500,000 for married filing joint, something like that. Yep. And then the final one there, which is probably a big one that's been in the news, is that increased budget to the IRS. So I think half of that budget is meant to go towards enforcement activities. The big thing to keep in mind with that is that it's not meant for anybody making less than $400K a year. But Biden said he's not going to try to hit anyone under $400K, but I don't know how that it's not going to happen. We haven't seen exactly how they're going to be enforcing this going forward. The layout and how the dollars are being spent. Keep in mind that the commissioner is stepping down this year. Revenue's done. So we're going to get a new IRS commissioner as well. So how all this is going to roll out, I know that's been the question that we get all the time. What do we think about this? It's not great news for our clients because it's just time wasted for all of us, right? CPAs and you guys, as you're going through an audit, is just time wasted. So hopefully these dollars that they put towards it go to actually processing the tax returns and getting caught up versus all this IRS enforcement.
Right.
So obviously we just had our election. As of this morning, I didn't see that they called the House for Republicans. I think there's one away, but it's likely going to be Republican. And the Senate is 50-49 without one vote, and Georgia still out. But because the presidency is Democratic, the vice president can break any tie in the Senate. Therefore, it's likely that we are going to have a split House and Senate. What does that mean for tax planning or taxes in general? Basically, we're going to have bipartisan support. Republicans don't want to raise taxes. Democrats typically want to raise money for certain things that they want to do. So likely not going to have a lot of tax changes in 23 and 24 with this new Congress. They're not going to be able to pass bills like they have in the past couple of years, as you can kind of see there, using that reconciliation process, where it just takes a simple majority. The Senate needs 60 votes. So we're going to maybe have some stability. Additionally, probably not going to be able to get any technical corrections on the Inflation Reduction Act. If you remember, we had that issue with TCJA and QIP deductions and how all that worked because they didn't write the code right. Probably going to have some issues with this, mainly because it's taxing big businesses, and I think big businesses have good tax attorneys. So I'm sure they're going to tear apart the bill. So we're going to just have to wait and see what that does. But for majority of us, that kind of gives us a little bit of stability going forward. So what does that mean for now to the end of the year? Because Congress, the people who got voted in don't take effect until next year. We're in what's called the lame duck session. What that means is it's still Democratic control through all three. But they've already used that Reconciliation Act on the Inflation Reduction Act, and typically you can only do that once a year. Technically, if you want to get into nuances, there's three parts of it, but in general, just say you see that once a year. So that means there's likely not going to be any new legislation that's really going to change up our taxing environment, which is great news for us, right? Because now we can actually see what's going to happen from this season versus next season, or 23 versus 22, and we can kind of start playing around that. That being said, the AICPA has noted these 4 big items that we need to see some sort of change, or we're hopeful that we see some sort of change. That first one, research expenditures, we're going to talk about all 4 of these in detail later on. That is the main key for a lot of people in Northwest Ohio. That's going to affect a lot of manufacturers, and is going to see a large tax increase to your 2022 bill if they don't fix this. The other stuff, interest expense and child tax credits, obviously going to affect us, but that top one is the one that really is driving the line. The good news being is we know that there's likely going to be 2 bills passed this year, mainly because that continuing resolution, that's our budget. So hopefully they pass that before December 16th when that expires. And obviously the national defense always gets passed. So Congress is great at tacking on tax things to bills that it doesn't pertain to. So we're hopeful that they're going to at least attach a couple of these onto these bills and hopefully make it a lot more tax friendly, more environment. Additionally, we're probably going to see the passage of SCARE Act 2.0 because it has bipartisan support. It's already through the House. It's in the Senate. They're probably going to pass it next month in December, wait till the end of the year like they always do. The good news there is it's very tax friendly for all the retirement vehicles. If we have time, we'll dig into the speculation what's in there. But that being said, like I said, we kind of want to think about, now that we have some sort of stability, hey, what do we want to do and how do we want to recognize our income? Do we want to expedite our income this year, maybe do a Roth conversion and maximize that 24% bracket, or do we want to take deductions? So it's kind of nice from a taxing situation where we have some stability. So speaking of tax brackets, Ruben, what are they?
Right. All right. So these next few slides here, we get into some more individual tax specific items. So we have in here, so we have the 2022 tax brackets, about 2023 on the next slide, and then the cap gain rates for 22 and 23 as well. The main kind of takeaways you want from these slides is the fact that the inflation adjusted numbers don't really come into effect until 2023. So obviously we know inflation is now, right? Like it's been a big issue for 2022. Unfortunately, we won't be able to really get benefit from that until 2023 and beyond. So just kind of taking a look here at the 2022 tax brackets, if you look at that kind of max income threshold for married filing joint, that's only about a $20,000 increase from 2021. And if I get into 2023, that ends up being about a $45,000 increase from 22 to 2023. So that's where you really start seeing those inflation adjusted numbers. kick in. So just something to keep in mind that for 2022, we're not going to get that benefit, even though we're kind of in the thick of inflation,
Right.
as it is. But you will start to see it in 2023 and beyond.
And the reason why we have these slides in there is because we want to make sure that you kind of see those jumps in those brackets. So like I said, we can kind of start playing around with these brackets a lot more because we have the flexibility to move income around and stability in our known taxes.
Right. Yep. And then, so here's our cap gain rates for 2022. Again, you're going to see a big increase from 2022 to 2023, not much of an increase for 21 to 22. And the big one that we can do from a planning perspective is in that 15% bracket. So obviously you see there's a pretty big jump from, the 83,000 threshold to the over 517,000 for the 20%. There's a pretty big gap there that we're able to kind of work with our cap gain rates to try and get within that threshold to play around with tax planning.
And one thing that to always remember is that it goes ordinary rates, then cap gain rates. So when you're calculating your income, you have to calculate your ordinary income first, then you layer on that cap gain tax. So if you have $80,000 of income, only 3,000 it's taxed at that. So again, it's just stuff that we get to finally play around with taxing situations that we haven't been able to do over this past however many years because of where we're at or what we had went through. I won't spend much time on alternative minimum tax. Those that are familiar with it, it's heads they win, tails you lose situation. You play a flat rate at 26% up to those amounts, and then it jumps to 28% thereon after. The reason I'm not gonna spend a lot of time is it doesn't hit a lot of people anymore because of those exemption amounts and the phase out amounts. Finally got an index for inflation. Prior to 2018, they weren't adjusted for it. Additionally, those preference items have been mainly repealed or suspended under TCJA. So preference items are the things that you got to add back for alternative minimum tax to calculate the income tax level or your income or your tax level, right? The reason why I want to point this tax out to you guys is because of the nuance within the SALT cap. The SALT cap is at 10K, and we're going to get into that. But the way the alternative minimum tax form actually reads, it says you take your tax that you actually are deducting, or your standard deduction if you're taking the standard deduction. Well, when we get to those, you're going to see that's a vastly wide range. So it may actually make sense to itemize and take less for your income tax, and that way you don't have to add back so much for your alternative minimum tax if you're in it. It's a little nuanced. I just wanted to point that out for those that are hit with AMT. Look at that because it's a juxtaposition to think, why would I itemize and get less? Well, you're not getting income tax, you're paying the alternative minimum tax. So it's just something to think about.
Yep. And again, on this slide, so not a ton of change here, but just some things we wanted to highlight that are still kind of out there. So you look at the Social Security tax, again, you can kind of see those inflation adjusted amounts don't really kick in until 2023 from a Social Security wage limit perspective, but no change to the amounts that are subject to Social Security tax from a percentage standpoint. Then same thing from the Medicare tax, no cap there. And then you have that additional 0.9% that kicks in on wages above $200,000. And then the bottom one there is a 3.8% net investment income tax on your passive income that's above $250 for marriage filing joint or $200 for single. That's been around for a while. Just something that we wanted to note, kind of make sure you keep in mind.
And to note that's only for passive income, so we can start planning around. Maybe you have an exit strategy and you're going to be exiting the company in 5 years, 10 years, whatnot. Or maybe your parents are still on there somehow. You have some weird strategy where you're passive. We can kind of talk about how to make you active to avoid that 3.8 because there's a lot of ways around that. All right. By some miracle, if you still have income after all of those taxes, the IRS has also instituted, or the Congress, I should say, has instituted this debt tax, is what a lot of people refer to it as. It's your estate tax, your gift tax. This has been around for a while now. We know that the exemption amounts are quite large. Keep in mind that they go down in 26, basically half of where they're at right now. The good news being, as you can see, that they finally increased our annual gifting limits. This year, you can gift 16K away per person, and next year, you're going to be able to give 17K away. So there's a lot of avenues. We don't want to dive into the estate and gift tax. It's a whole different presentation. There's a lot of fun stuff, but if you haven't looked at it, look into it, because we don't want to get to 2026 and all of a sudden lose a big opportunity to avoid this estate and gift tax, which is a flat 40% tax rate.
And then this slide here, again, just kind of just some reminders out there of what these amounts are for standard deductions and your regular exemptions. So we have married filing joint, single marriage filing, single and head of household. Again, you kind of see the inflation adjusted amounts not kicking in until 2023. But just kind of keeping in mind, and in a lot of cases, these end up being higher than your itemized deductions, especially with that cap, the SALT cap limit in there. So just something to keep in mind as we go through there. And then again, a note at the bottom to kind of remind you that the personal exemptions that we used to have a few years ago are no longer there. Or I guess they're there, but technically zero.
There's zero. It's not technically repealed, it's zero. It's a nuance that Ruben and I geek over. Again, yes, that is true. We geek over that. So we talked a lot about standard deductions and then itemizing to avoid some taxes. We wanted to just take a second to remind everyone, what are you actually allowed to deduct? Because it's estimated right now that 93% of the population is taking the standard deduction because they're so high right now. But if you do find yourself in a situation, we wanted to kind of talk to you through a couple of strategies that we use internally for our clients, just to help them maximize their deductions. So as you can see, medical expenses at 7.5 of AGI, it was going to go up to 10, it never did, and now it's permanently back to 7.5% of adjusted gross income. What that means, if you make $100,000, you have to have $7,500 of medical bills and before you can even add to the ability to deduct them. So anything above the 7,500, you can add to your itemized deductions to see if you can get above that 25,000 limit. Most people don't hit that, but I wanted to take a second to point out that timing of the payments is key, right? Because all individuals are considered cash basis. So if you have a procedure coming up, or you just had a procedure or something like that, you may want to wait till next year. Or if you have a procedure in January, maybe you can accelerate the payments now or do something just to try to maximize that benefit. The SALT cap, we're going to get into that in a couple slides. Some workarounds there. That's been the hot button topic for a while now. So nothing new there. The cap is still there on 75K or 750K. Main thing here being is your home equity line has to be for your home. It can't be for buying a car anymore. But with interest rates where they're at now, I'm not sure you're taking out a lot of loans on your home equity, but they're still historically low rates, I guess. Also to remember, investment interest expense. If you borrowed money to buy stocks, you can deduct that as long as you have dividend income or interest income. You have some sort of income on that, you're allowed to deduct your investment expense up to it. Also note, there's an election you can actually make to have your capital gains taxed as ordinary rates to be able to free up this investment interest expense. So if you have large interest expense carrying forward, maybe you want to look at just making that option. It's an annual election, so it's not like you do it every year. The other items that we always talk about is if you're going to make contributions, maybe think about using highly appreciated stock instead of actual cash, because then you don't have to actually recognize the gain and you get the deduction at the fair market value for it. So it's kind of a real benefit and what we obviously recommend to a lot of our clients to do. And then obviously the QCD, qualified charitable distribution, it goes straight to the charity. It's great because you can avoid that income. If you're up in the RMDs and you have to take out an IRA or your distribution, you don't need the money. Keeping that income off your adjusted gross income is amazing because, again, medical expenses and other things like that. Additionally, most likely, if you're taking those out, you're capped by the SALT, so that's 10K there, and you probably don't have mortgage interest. So you got, as Ruben pointed out in the previous slide, you got another $15,000 of it to get to be able to itemize. So you're losing that 15K if you're doing it that way. The other two items, gambling losses to the extent of gambling winnings, that's always been on there. You can still do that. Just know you got to be able to itemize to get the benefit for that. And finally, we wanted to make sure we pointed this out. I know a few of the people on Zoom here were in Fort Myers during the hurricane, and it was federally declared disaster. And the casualty losses rules are still out there if it's federally declared disaster. So if you're out actual cash dollars, insurance money didn't cover it, you can actually claim the casualty losses. There's some hoops you got to jump through to get it filed correctly, but it's out there. Know about it, and just hopefully we can help you out on that. So
this next one, child tax credit. So as Bob kind of noted in earlier slides, this is one of those items that the organizations in our profession have kind of noted as something that we need some answers on, some possible legislation on. as we move forward into the next couple of years. So the child tax credit was something that had a pretty big change back in 2021. If some of you, like Bob and I, had kids, it was pretty big ticket item for us. So this was something, if you recall, that in 2021 they kind of started throwing out advance payments. They made the credit fully refundable. They increased it to $3,000 from $2,000 if you had a child over 6, and they increased it to $3,600 from $2,000 if you had a child under 6. And again, that credit was made fully refundable. And so they started making those advance payments. They kind of were able to do some tax planning stuff if you had kids, to kind of utilize some of that credit and take advantage of maybe some extra income or doing some different things with IRA conversion, stuff like that. So there was some proposal in the Build Back Better bills and some of the other legislation that was going to extend that increased credit over the next year, the next couple of years. The thought process kind of being, once that's kind of there, it's going to be hard to kind of take it away. Again, as we mentioned, none of that stuff came to fruition. So the child tax credit is back down to what it was before. So that means the credit's back to $2,000 per child, no matter what age they are. And only $1,500 is refundable. Not the full amount is refundable anymore. The phase out remains at $400K. They increased the limit, I think, for 2021 to 17. Correct? And that's back down to 16 now because of the old rules. So that's just something to keep in mind, that it was a pretty big change, especially if you had multiple kids. I mean, I have 2 kids. It was $3,200 difference. So it was a big ticket item, just something to keep in mind as you go through planning. And then kind of related to the child tax credit was the dependent care credit. Again, that was another for any of you guys that have kids in daycare or just doing summer camps, things like that. The dependent care credit was increased quite a bit for 2021. So if you go back pre-2021, there was a $15,000 wage limit that if you were above that, then your credit was capped at 20% up to, I think it was a little over $400,000 of income. And the eligible expenses were $3,000 for 1 child or $6,000 for 2 or more kids. 2021, they increased that eligible expenses from 3 to 6 to 8 and 16 for 1 kid to multiple kids. And then they increased the credit amount to 50% up to $125,000 in wages. So really big dollar amounts and really big changes there that some of you might have been able to take advantage of for 2021 from planning opportunities. That is back down to normal levels. So that credit is now back down to a max credit of $2,100 if you have 2 or more kids, and you have to be under that $15,000 limit. Obviously, most of us are not under that limit. So you kind of get capped at what you're able to use. So a pretty big change there as well. Next slide here for retirement purposes. So just kind of wanted to know what the contribution limits are. So for 2022, you can kind of see those there: 401k, SEP, IRAs. Not a ton change for 2022, right? The big ticket items, 2023 again. All kind of very familiar. I don't know if you had anything specific to add there, but pretty straightforward.
Yeah, just always keep in mind that if you're above the limits for a Roth IRA, you can always do a backdoor Roth. Backdoor, what I'm meaning there is there's a cap of how much you can put into a Roth IRA, which is basically when you retire, you can take that out tax-free, including the earnings. If you make too much money, IRS doesn't let you do it. However, there is no limit to convert or roll a traditional IRA into a Roth. You can do it once a year. So what a lot of people do is they can put into a non-deductible IRA and then roll it into a Roth, and you're only taxed on the gain. If you're going to do that, I recommend, I'm more conservative on this piece than most of my taxes. As many of you guys know, I'm an aggressive person when it comes to taxes. When it comes to these, I am a little bit more conservative on my backdoors. I wait a month before I roll it or convert it, mainly because I want that one paper. I want that one statement to show up to prove that, hey, I opened it and I didn't open it up and immediately roll it. Because there's a thing in that got codified in the 2010 health bill that's called the economic performance or economic substance standard, but basically says, if I see that you're following all the facts to get you here, but you were really going this way, so because of that, we're going to disallow all the paper that you did. So that's why I say wait 1 paper, wait 1 month, get it, and then roll it. So these are some code sections that have been around for a while, and we just wanted to point them out this year because, again, we got some stability, some ability to take advantage of these if you qualify. 1202, I spoke a lot about last year. If happy to dive into details with you if this pertains to you. offline, but basically I just want to hit high level. It applies to C corporation stock that you originally acquired from the business after these dates. If you did, you can qualify to exclude 50, 75, or even up to 100% of the gain, assuming that you meet all the qualifications. This is a great code section. It really has come about because of PCJA's tax cut to the corporate rate, which took it from 35% down to 21%, which made it more palatable to be a C corporation. So because of that, we're actually going to be seeing a lot of 502 transactions happening. On the other side of that, if you have a loss on your stock, which again with the market, you may actually do have a loss. There's a code section, it's called 1244 that's been out there. You don't see it very often. The main qualification for this is when you bought into that company, you had to be under $1 million of equity. So for those smaller businesses, when you started them up or something like that, you do have the ability to deduct up to $50,000 as an ordinary deduction and not get capped by that $3,000 cap loss that we know is out there. Basically, if you're a corporation and you have that loss with under $1 million, you can qualify. So I think it's just good to know that it's out there. It does apply to S corporations, but I haven't come across a situation where I still have basis in it if I'm going to sell it for a loss, because typically my ordinary losses or the ordinary losses, they take out my basis. So I haven't really come across that too much.
And then virtual currency here. So we could probably do a full webinar from a virtual currency perspective. But still not much change from past years. So there was a lot of talk in some of that pending legislation that was out there a year ago that had some pretty big changes for virtual currency, like in the legislation, from changing reporting requirements to taking out wash sale rules or applying wash sale rules for them. Again, none of that came about. So virtual currency kind of stays status quo. The big item from this, big takeaway from this slide is that last bullet point there on the slide, in that wash sale rules do not apply for virtual currency. So that means you can sell, some Bitcoin today at a big loss, buy it back tomorrow, and still recognize that loss. In a normal stock transaction, wash sale rules apply, where if you sell that today and you buy it within a certain period of time, again, that loss gets disallowed. So really big planning opportunity there if you have some losses there that are probably there from the way the market's at. So
All right, jumping into the SALT deduction and the workaround for the states. So this is a very beneficial rule for a lot of Ohio businesses. So first, what's the cap? The cap's at 10K. If you on your individual return, if you have more than that, you're unable to deduct that. That includes real estate tax and any income tax that you pay to Ohio or the cities or whatnot through, I guess, on your individual return. And the issue being is pass through partnerships and S corporations income are reported on an individual return. We know that. So now all of a sudden we got capped on those dollar amounts that we were able to deduct in the past. So what happened is notice 2020-75 came out a couple of years back there, obviously. And what it said is the IRS is going to issue regulations that will allow you to deduct the partnership and S corp taxes for state and local at the entity level, no longer at the individual level. And why that's huge is many states have now come out and allowed a credit for that, meaning that I get a entity level deduction, a federal tax deduction at the entity level, and when I file my individual return, they're going to pass a credit down. Ohio just came out with theirs. They passed it in was it July, and it came effect in September. And basically we have a brand new form that says, hey, you know what, you can deduct and pay all your taxes at the entity level, and then we're going to give you a credit for that amount at your individual level. So obviously huge deduction, especially if you're in the top rate of 29.6, you're going to get a nice little deduction for that. There is some nuances in it, and it's still early on. We're still waiting for Ohio's guidance on a lot of it. But basically what it is, it's going to be a 5% flat rate for 22, 3% after that. And if you're an Ohio resident, you can file this form at the entity level. Before, if Ruben and I owned a business, we wouldn't file at our entity level for Ohio because we're both Ohio residents. Didn't make sense. Now we can actually do that. Additionally, there's no penalties this year, only for 2022 for late payments or anything like that. The way you make this election is when you file the actual tax return, which is really beneficial because that's going to give us time for planning and projections to figure out what we want to do and how we want to maximize this benefit. So you can kind of see there's actually 3 different forms you can file for Ohio: 4708, which is a deposit, the IP 1140, which is a withholding. Honestly, I don't think anyone should be really filing 1140 unless there's a real specific reason to. And then this new 4738, and all the payments can be transferred back and forth, which is again really great, really beneficial for a lot of our Ohio businesses. That being said, the way the Ohio code revision is written is, if you're an Ohio business, great. If you have business in other states, not so great for this pass-through entity tax. And what I mean by that is Michigan and California, New York, all these states are obviously passing this to get the benefit for their residents, right? The way Ohio code is written right now is if you pay tax to another state, you get the lesser of the actual tax paid, or how Ohio would impute it, right? Makes sense because California, they're at 13.3% if you're a millionaire, versus Ohio's 3%. They're not going to refund 10% to you because you paid it to California. So they're just going to limit you to that 3%, assuming you're above $250,000 of income. Well, the way the code is written, you see that on the second bullet point there, is it's saying if it's deducted at the entity level, meaning the federal level, you're not actually incurring that tax. Your business did. Therefore, you're ineligible to claim that credit. So electing for Ohio pass-through entity tax makes a lot of sense for Ohio residents. If you're going to elect for Michigan and you're Ohio resident, doesn't make sense right now. We got to run the math. It could make sense, but there are some nuances within that. So be careful of that, especially because Michigan's one of those, that's a 3-year irrevocable election. So we may want to just hold tight. The good news is we still have time before you make any of these elections for a lot of these states to figure out all the nuances with it. The very last thing I will point out is I mentioned partnerships and S corporations. If you are a Schedule C or your rentals are reported on your individual return, well, rentals, you're taking taxes against that. But if you're reporting those on your individual tax return, you are not eligible to file these forms because they are entity level taxes. So that's one thing to think about. Maybe it's time to take your Schedule C and flip it to an S corp or something like that, because it can help benefit you.
Right. Yep. So this final slide here for the individual side is just really a good summary of just some general tax planning ideas that you can look at as the end of the year approaches. So that first one, if you have some big capital gains out there that you are kind of worried about recognizing, and you have some potential stock out there that you could get a loss on, good to think about recognizing that loss and minimizing that capital gain. Also, if you feel like your tax rate is going to be pretty low this year comparable to other years or in future years, you might want to think about reporting some of those cap gains this year to kind of take advantage of that lower tax rate. And then that just kind of there as well, a big tax planning idea if you are invested in that virtual currency is the fact that loss shell rules do not apply. Yeah. So you can take that big loss on the sale of some Bitcoin and get a real big advantage of it and just buy it back the next day or the beginning of the next year. Yeah. If you need to. From itemized deduction standpoint, obviously you can group expenses, whether that be charitable contributions, medical expenses, things of that nature. You can do that through the qualified charitable distribution that Bob mentioned. You can also do that through a donor advised fund that kind of lets you group all of your charitable contributions in 1 year, and then that fund kind of distributes it out as you request them to. And then finally, you can use 1202 and 1244, as Bob kind of touched on a little bit, to get some tax benefit from any stock gain or loss, potential loss.
So basically, in your individual return, this is the year to kind of look at what bracket you're falling into, and then either try to get you down one bracket or maximize that bracket, go all the way up to that 24% threshold and pay the tax at that. Because we're not seeing taxes decreasing anytime soon, and we know in 26 they're sunsetting, so they're going up. So it's just making sure we're paying attention to that stuff. Yep. All right, switching gears. I kind of mentioned a lot of these at the beginning under that lame duck session, but we want to get into what these actually mean for our businesses and why they're so important and why we should keep our eyes on them. So this research and experimental expenditures, code section 174. A lot of times you'll hear us talk R&D. R&D is claimed by a lot of manufacturers and a lot of people because it's not just specifically to manufacturing clients and not specifically to lab coats. Right, we think R&D, we think lab coat speakers, all that good stuff. That's not the way the code section is actually written. the code section basically says if you're doing anything that's new and you're funding it and it's part of the tangibles, all that stuff, once you get through there, it can be considered R&D expenditures. Well, let me back up 1 second. So what is this new code, or what is it saying? So basically in TCJA, it came out that in 2022, we have to capitalize all these expenditures. And you have to amortize them over a 5-year period. No one thought we would actually see the day that this happened, because it was put in TCJA, part of the Reconciliation Act, to make sure we didn't add to the deficit after 10 years as a revenue generator. We thought at some point in time this would get fixed, punted, pushed down the line. Well, it didn't, and it's here. And what that means to all of anyone who's out there claiming 174 expenses or R&D expenses is, if you claimed $1 million of R&D expense last year, you're going to have to report 900,000 of that, or 900,000 of that's going to be disallowed this year. And you're like, well, 900 doesn't make sense. How do I get there? Well, the first year is half year life for any makers or acres depreciation or amortization. So you only get half of that first year. So it's 5 years split. You divide it by 5 and you only get half of that first year. So $900,000. So assuming you were break even last year, this year your taxable income will be $900,000, which is huge. Especially because 174 is broad. It's not just your wages you spent to do that. It's the overhead costs that are associated with it, right? The rents, the utilities, all of that stuff that go along with all of expenditures. And I believe this is going to be a very easy thing to audit, because did you claim 170 or did you claim R&D credit last year? Well, then you're going to have R&D expenses this year. So we just need to make sure that we're planning for these. We're very hopeful that it's going to get attached to one of those 2 bills. My fingers are crossed, but obviously we just want to make everyone aware of how big this can actually be for you. The bad news being is we don't have a lot of court cases on 174. What is and what isn't. The reason behind it is we haven't really cared in the past, because there's no credit that's generated off of 174. It's Code Section 41 that generates the credit. So no one actually challenged what 174 is. And if it's 174 or Code Section 162, which is your ordinary business deductions, who cares, because you're still getting a business deduction. So no one's ever really challenged them. So we're going to see what's going to happen with this going forward. So just something to keep your eye on. Very last thing I will say, and of course they're going to do this, is that they are making this a change in accounting method, meaning that we have to file a 3115 for you if you have these expenditures. So just makes your tax return longer and more complex, because we have to follow the tax law, and we're going to make us. It's a joke, but it is what it is.
Right. Yep. So bonus depreciation is another big item that's going to be changing after 2022. So 2022 is the last year that you have 100% bonus depreciation. So definitely something you want to keep in mind as this end of the year approaches. And if you're thinking of potentially doing any fixed asset purchases, it might be a good idea, if you're thinking of maybe pushing those off to early 2023, to have those end 2022 and get the benefit of that full deduction. Because as you see there in 2023, it starts off at 80% and 60, 40, 20 until after 2026, it gets down to 0. So this is something that's generally been extended in the past, but just not sure where it's gonna go in the future. But definitely something that we wanted to make you aware of, the fact that 2022 is the last year for that 100% deduction as you go forward.
Yep. We still have the option for 179, which we'll talk about shortly. Bonus depreciation has been around since September 12th, 2001. It obviously was put in effect because of 9/11. And we have seen some form of it every year except for 2007. We're hopeful that this gets it. Even President Obama in his blue book, he wanted for immediate expensing of all of it, even land. And I'm like, that just keeps things more simple across the board. And I think everyone agrees with that. At the end of the day, it's a timing difference. So we're hopeful that we're going to see something, and we're going to continue doing this, because once you sell that and you fully appreciate it, you got to recognize all the gains. So it's just a timing difference. So hopefully we can see something on that.
Yeah.
This is, I don't like this code section. It's Code Section 163J. It was put in TCJA to help with the reconciliation. It's a revenue generator. It's a pain to calculate depending on what level you're at and how many pass-throughs you have and all that good stuff. But basically what it says is you can't deduct interest expense if you have a loss. And how we used to calculate interest expense is changing in 2022. So before it used to be called adjusted taxable income, or EBITDA. is how they would define it, and those last two being depreciation and amortization. As Ruben just talked about, we've been using bonus depreciation since 100% since 2018. So we've been fully depreciating all these assets, driving your taxable income number as low as we can get it, which is great. And then we can add that back to see if you could then qualify for that interest expense deduction. Well, now 2022, we're no longer able to add back depreciation and amortization. So we're going to drive your income down with those adjustments, but then have to not add them back to see if you can take that interest expense. So it could be a limitation. So depending on how this bill shakes out, I personally don't see a lot of traction on this. I haven't heard a lot of traction. It doesn't mean there can't be. I think this is just because it doesn't affect everyone, and it's just those that are leveraged, typically highly leveraged individuals. So they may actually allow this to stay in. Again, not sure what where we're gonna end up, but it's just something to keep our eye on as we move forward.
Yeah, for sure. So the qualified business income deductions, this is something that's been around since TCJA, been around for a while. I think it's something that we all are pretty well versed in. But you guys as clients, businesses, us as professionals, pretty well versed in qualified business income deduction. There hasn't been any changes.
Right.
This is another one of those things that there were some changes talked about, some of that legislation that was out there in the last year, but nothing that came about. So just very high level, this deduction essentially gives you a 20% deduction of your business income for pass-throughs. So partnerships, S corporations, depending on what kind of business you are, depending on what income level you're at, you might have to think about how much wage you're paying, how much fixed assets you have. If you're a lawyer, accountant firm like us, some of that stuff kind of plays into it as well. But just kind of a reminder that the deduction is out there. It's still out there through 2025. So we still have a few years with it, but then after that, it is gone. So as we move forward in the next few years, we kind of want to think of that and don't necessarily rely on this deduction 100% to kind of keep things going.
Yeah.
And then some other business provisions here. So K2, K3 was something that was a pretty big item here towards the tail end of 2020 or 2021. Yeah. So a pretty big item here, like within our firm and definitely within the profession as well. So if you think about when you get a K1 from a partnership S corp, all of your foreign information typically was reported on one of the codes on the face of the K1. And then sometimes, depending on what the firms did, it'd be back in your footnotes and certain schedules, worksheets, whatever, they would kind of add to it. So the IRS with this K2, K3 really wanted to try and standardize your reporting of financial activity for business. So they came out with these K2, K3 schedules, and they're pretty convoluted, very long. When we were starting to look at them, and very early on, it seemed like we were going to have to do them for pretty much all of our clients. And it was just going to be very time-consuming process on our end. It was going to be time-consuming process on the business and client end to get us the information that we needed to actually report. And then so there was a lot of pushback from the profession to get these delayed. So the IRS kind of allowed for a little bit of leeway in that. So I think they're coming back a little bit for 2022. Mm-hmm. There's still some pushback on getting those delayed further, getting some further exemptions for businesses so they don't have to worry about this burden, especially if they don't have a ton of foreign activity. It just doesn't make a ton of sense. Mm-hmm. But just something to keep in mind, if you get a K1 and you see these schedules in there and your K1 went from 5 pages to 20 pages, this is one of those reasons why.
And the whole reason why is a lot of you are probably saying, well, I don't have any foreign activity. The issue is if you have foreign tax credits on your individual return in excess of 300 to 600, if you're depending on your marriage situation, you have to report this information. So if your investments, or if you own Honda stock or something like that, and you're getting these tax credits on your brokerage statements, you're going to have to report all this information, and it is burdensome and it's convoluted, as Ruben pointed out. So we're hopeful to get some more guidance on that and just say, hey, let's get some simplicity. At the end of the day, that's all we ever ask for. We don't mind reporting the information, but just simplicity out of it.
Right. Yep. The next note there is the shareholder basis items. So that's something that's come about for both partnerships and S corps over the last couple of years, where the IRS has required us to start reporting basis with the K1s. So that's just something, as you receive those, as you're getting those as a business owner, and you see that in there that hasn't been in there before, it's an IRS requirement, and it's just another item that we have to include with the returns. And then finally, that section 179, as Bob mentioned, that's still out there. So even though bonus, the 100% deduction is going away after 2022, you can still take 179 on those phase out ranges that are listed there. And then the other thing to keep in mind on some property that isn't necessarily bonus eligible, they did expand 179 to include those types of assets. So things like roofs, HVAC systems, things like that aren't bonus eligible are still 179 eligible.
Yeah. The only hiccup with 179 is you gotta be active in the business. So if you're passive, you're not gonna be able to qualify for it. So getting close on time. So meals and entertainment, we still get 100% deduction this year. Keep going next year, we're gonna drop back to that 50%. Keep in mind this with the COVID relief to get people back out eating in a restaurant. So still have 100% this year.
Yep. So employee retention tax credit, could spend a lot of time here. I know this is something that we've hit a lot with our clients over the last year, vetted 2-3 times over just to kind of make sure that we were really making, really able to get the benefit, because there's a lot of benefit potential here if you don't know about it. So it's something that I've kind of specialized in over the last year plus. So if you have heard about it, want to know more about it, feel free to reach out. So it's a credit out there that's available for eligible quarters from second quarter of 2020 through third quarter of 2021. And a lot of big numbers out there. When we start doing it for clients, the numbers start adding up really quickly. So a lot of benefit out there. If it's something that you've heard about, something you want to look at, whether you're a client or not, feel free to reach out and we can do that analysis for you. The other thing to keep in mind with this is we're seeing a lot of predatory behavior from businesses out there regarding the ERTC in regards to reaching out to businesses that may not actually qualify, but saying they qualify for X, Y, and Z, just to get the fees. And so that's a huge risk, obviously, for you guys as business owners. So just something to keep in mind with that as you get some of those notices, because I know a lot of our clients have gotten emails, calls from people wanting to do the credits for them when we've vetted it out multiple times over that they don't qualify. So it's just kind of a risk there.
All right, as I mentioned at the beginning, there is a more than likelihood that the Secure Act 2.0 will be passed this year. And again, it's mainly great benefit across the boards. You're gonna have higher catch-up limits. The R&D is gonna get bumped to 75. There's not 100% certain what's all gonna be in there because it's still in the Senate. We gotta see what the bill comes out at, depending where they're at. But there's gonna be like disaster relief, kind of like during COVID. There's gonna be that ability to avoid the 10%. Along with recognizing the 3 years. So there's going to be some really great benefits, hopefully, out of this. Many of us don't in the profession don't even recall Secure Act 1.0 because it got passed in December of 2019. And then we got a bunch of bills passed that following year. So again, this seems to have a lot of traction out there.
So finally, some things to keep in mind if you're looking to increase your deductions for 2022. Accounting method changes that are available. Some of these are available to small businesses. So that's 27 million for 2022 in gross receipts or less for the last few years average. You can change it for the cash method. You can elect to not keep an inventory depending on what you're doing for work purposes and internally. 263A is a big one that you can elect to no longer calculate because that calculation is just kind of ridiculous for a small amount. And then also there we have the ability to deduct prepaid expenses for eligible prepaid expenses that's available there as well.
Yeah, so that'd be your intangible prepaids, meaning your insurance, stuff like that. You can't prepay for inventory, then write that off.
Right.
But if you haven't looked into that in the past and your income level's high, especially if they don't fix this whole 174 issue, we may want to be looking at doing that for you.
Yep. And obviously there we have bonus depreciation, which is the kind of normal one over the years. You can take a look at your assets to see if they might qualify for a shorter life. LIFO is a big one that I know Bob specializes in quite a bit, that there's some potential there from the inventory's perspective to change the LIFO method and get some real big tax benefits on there. And then that final one is just kind of a reminder that if you have real bad debts, make sure you're actually writing them off. So for tax purposes, if you're just increasing the bad debt allowance, you can't get that deduction. It has to be an actual legit write-off of bad debt.
And circling back to that bonus depreciation, you can kind of see that place in service. You can't just buy the asset, you actually have to have it and use it by 12/31 to get that 100% bonus depreciation. And then reviewing your assets for shorter lives, it's a great opportunity, especially to look into what's called cost segregation. If we're able to get your lives down, we're able to then use that bonus depreciation and really help cut some of your expenses. Switching gears, if you're looking to increase income, maybe maximize that bracket, like I've kind of talked about a couple times throughout, look to go the other way with your cash flow accrual, right? I mean, if you're able to really maximize those lower brackets and take advantage of it, it's great. Now, you can't then go back next year. There's a 5-year waiting period for you once you flipped. So just be aware of that, but it could be really beneficial to take advantage of these historically low rates. As Ruben mentioned, maybe we accelerate your capital gains tax all the way up to 500,000 even, right? Because we got up that until we get to the next level of 20%. Got to factor in 3.8% though. So it's just something to think about and how we want to play around with that.
Right.
And then this is one that I always like to point out to individuals. We know that if we're going to deduct our accrued wages, accrued bonuses and stuff, it had to be paid within 2.5 months. Well, if you're looking to maximize income, we'll just pay it the day after 2.5 months.
Right.
So your employees are still getting the money, but now you're no longer allowed to take that as a deduction. So in summary, I think we're pretty good on time. At the end of the day, timing is everything for these next couple of years, which is good. So we can kind of play around with that. So we can see where we want to recognize income and not. And keep in mind, guys, I know we've been saying it, but 2026 isn't that far away. 2025 is the last year for a lot of these provisions for individuals. There's 23 of them which will sunset or expire in 2025, and they're all basically individual taxes. So taking a look at making sure that we're not only planning for this year, maybe down the road. Who knows what's going to happen in 24 elections? I don't even want to speculate on that. Just be aware of that. And then finally, all eyes are on the lame ducks season, as I like to call it, is we're going to see what's going to happen. Are they going to fix 174 or 163J, or what are they going to do? So it's going to be interesting. So, and that is us.
Well, thank you so very much, you guys, for coming on here and providing us with that information. Thank you to Michelle for answering those questions that have come up. This basically concludes our webinar. I'd like to thank everybody for attending. Please note the presentation materials will be made available in the coming days, along with a recording of the session. Please keep an eye out for correspondence from us with a link to that recording. If you have any questions, that contact information will be included in that follow-up correspondence. And as always, stay tuned for more webinars that we're putting out. We really appreciate your attendance, and we appreciate you taking part. Thanks again, everybody.